Ben Bernanke today saying the recession is over. The caveat, the recovery will not be immediate. Going to take some time. Warren Buffett agrees. We'll hear more from his interview with Becky Quick in just a minute. But before we move forward, check out these three stocks. Goldman Sachs, near a year high. After a bit of a dip today, the stock stands at $178.80 a share. That's about 30% above where it closed a year ago. 3M hit a new high today. The stock at almost 75, up 9% from where it closed a year ago. Check out Google. It hit a new high today as well, closing at 476 and change, up 10% from a year ago. Those stocks kind of make it clear that comebacks are possible and are happening. We kick off the big show now with Rick Santelli in Chicago. My pal Bob Pisani's at the big board. Bob, how has the mood changed over the last 12 months? And is there more optimism tonight than we've seen in a while?
There has been more optimism, and that's because the economic news is getting better, Mark. Let me just show you some stats here before I give you some ideas about what's going to happen in the near future here. Take a look at the Dow 1 year ago and the Dow from the bottom 9 months. Here it is. 1 year, we're still down 15% compared to where we were last year, but since the March 9th bottom, up 48%. Now, I know you think, all right, it's all financials. That's not true. The real market leader has been technology stocks. In fact, we're just about back to where we were with the technology sector, exactly where we go 1 year ago. It's only down 1%. And since the March 9th bottom, up 67%. Now, as for the financials, yes, they've been a more volatile roller coaster ride, but they're still pretty hurting. Down 30% compared to a year ago, March 9th bottom. Look at that, up 136%. Let's talk about where we go from here, because that's where everybody is focusing their attention right now. The general feeling, and there is debate, but the general feeling is the economy is going to continue to show improvement. That's the most important fact. As for whether rate hikes are coming, we've got a low 10-year Treasury yield. We've got a weak dollar. As of now, the market's saying no rate hikes anytime in the near future. How about that dollar weakness? Endless policy debates down here on the floor. An orderly decline, orderly in the dollar, good for U.S.-based multinational stocks. How about the earnings revisions? Have you noticed in the last 6 weeks I've been talking about all these analysts bringing their revisions upward? That's a very good sign for the overall market. And finally, you're in one camp or another down here on this double dip. You're either for it or against it. Most traders think it's possible, but the odds of it happening are fairly low right now. The stimulus out there is too powerful. Hey, Rick Santelli, massive new issues of treasuries in the last several months, and yet rates still relatively low.
And not only that, Bob, today we had $20 billion of corporate securities, Citibank among them. Hey, a year ago, issuance wasn't easy. Of course, the government, ended up putting guarantees in place, and those guarantees on issuance may still be in place for the likes of Citi. But look at where we were a year ago on a 2-year note. This one's easy. Of course, we're lower because the Fed basically lowered rates down to 0. 10-year no yield? It really hasn't changed much. As a matter of fact, we're within 6 basis points. It was slightly under 340. We're just below 350 now. If you look at the dollar index, it's easy to tell where it was a year ago, because it was right where it is today as we hover near 1-year lows. And the last chart, so much debate. Here's a 1-year chart of gold. So we're up about $100 over the year. But listen, viewers, I understand a weak dollar is going to propel dollar-denominated commodities higher. But the gold story's more than that. I think many thought that during the height of the crisis, gold would be at 1,500, 2,000. And even though it is up, we're still flirting with 1,000. Listen, the Treasury complex is still hunkered down, still a safety trade, but a lot of the very functioning parts of the gears, things like LIBOR, commercial paper, they have definitely healed, so there has been progress made. But boy, when we get over 4.5%, that might be the best all clear that the Treasury complex doesn't need to be the safety harbor that it has been for the better part of the last several years.
Rick, a year ago, it was pretty easy to gauge the health of the credit markets in general by looking at the 3-month bill or the 6-month bill, which were hovering near 0. But since the Fed set the unofficial rate near 0, that, of course, doesn't work anymore. What do you watch to get an idea of how healthy the big picture credit market is? Is it LIBOR or what?
Well, I would personally be looking at something like a 3-month bill and looking to see if we can get it above 60, 70 basis points. That would be one. But I think more generically, and remember, we have a minus 2% year-over-year CPI. We'll get an adjustment to that tomorrow. So you could really say a 10-year note's real rate is 2 percentage points higher than where it's trading. But I'll make it easy. When a 10-year note closes above about a 4.25%, I would think that one could then surmise that safety isn't king and maybe risk will come back outside of what we see in equities.
So we can watch the 10-year. Okay.
I think that's good.
Bob Pisani, of course, you and I spend every day down at the New York Stock Exchange, and my impression is, you were talking about possibility of double dip. What are the odds? My impression is, I don't know about double dip, but boy, there is still a world of skepticism down there about the rally.
Yeah, and traders love that because the bulls say there's your best argument for why the market will advance. So call traders. I was at a gathering of 20 hedge fund traders last night. I've never seen such a conflicted group in my life. Many of them are in the camp of the double dip, maybe as many as half. But I asked them, so you're shorting the market? And they say, oh no, we're long the market. I said, how can you be so skeptical and be long the market? Because they have seen what's happened to people who've tried to short the market. So even though skepticism is high, traders are still reluctantly net long the market right now.
Yeah, well, there's a lot of fear of being left behind, too.
Exactly.
Because a lot of them were left behind when this thing took off back in March. Thank you, Rick.
Okay.
Thank you, Bob. Now we're moving to the Oracle. The Oracle. Becky Quick sat down with Warren Buffett. He's seen his ups and downs in the last year or so in his entire career. Becky is live. Oh, tough assignment, Carlsbad, California. Oh, are you kidding me?
It's a tough assignment. I took it on because, hey, somebody's got to do it, Mark.
Yeah.
You know, we sat down with the Oracle of Omaha, and in the weeks and the months leading up to that one-year anniversary of Lehman's collapse, we've been hearing from a lot of the major names on Wall Street, all of them talking about what was happening from their perspective. Now, I know Omaha is a long way from Wall Street, but you can bet that the Oracle of Omaha was involved in what was happening that weekend. He was taking a lot of different phone calls. And so for the first time on camera, he sat down and told us what that weekend looked like from his perspective, what he was hearing, and the role he did and did not play in what was happening that weekend. We talked to him about that, and we also talked to him about whether or not Lehman should have been allowed to fail.
Well, I think Lehman was destined to fail unless the government came in big time, and you know, for one reason or another, they generally say they didn't have the authority. My experience usually is that whatever the government wants to do, they find the authority. But listen, if Merrill Lynch hadn't gotten sold on Sunday, what would have happened Monday would have been off the charts.
So the more important one to save.
Lehman probably should have been, not saved isn't the right word, but transferred in some kind of an orderly manner. I mean, it was the chaos that came after the fact that it just happened, and there was total disorder. And I think the trustee for Lehman has said between 50 and 75 billion at Lehman itself was lost unnecessarily because of the disorderly way that the liquidation took place.
Obviously, there were a lot of calls that were going on behind the scenes at that point. Were you a part of any of those calls?
No, I got a call. I was in Edmonton at a social event. I was at the hotel about 6 o'clock or so Edmonton time, and I did get a call from the head of Barclays, Bob Diamond, and Michael Klein, who was an investment banker, and they had just learned apparently that the British authorities would not allow them to take over all of Lehman. This was not just the part that they took over later, but they were talking about coming in and taking over Lehman. And the British authorities had said if it involved more than £3 billion, as I remember, it needed the vote of shareholders, and that couldn't take place till sometime later, so they were asking if we would write an insurance contract that would protect everybody on the other side of trades until they got that shareholder approval. So they were looking for a solution, I can tell you, at about 8 o'clock on Saturday and 8 o'clock in the evening, and they didn't find one.
Were you surprised? I mean, what happened? Did you turn down this offer? What happened?
Well, what happened is they described a transaction to me that I really couldn't grasp quickly, and so I asked them to send me a fax at the hotel. I was going to go to this social affair that would break up around midnight. Send me a fax that explained the transaction in detail so I could understand it. Tell me how much of a limit they needed and how much of a premium they would pay, and then I would get back to them promptly. I'd call them that night. And because it was a complicated transaction they were describing. I didn't fully understand it, and people were waiting for me downstairs. Anyway, when I got back to the hotel that night, around midnight, there was no fax. Apparently it blew up at some point in that period.
What did you hear afterwards? Did they explain to you why, or what?
Well, I don't know why they felt the transaction was unfeasible, or I don't know if for some other reason that Barclays decided they couldn't go ahead with Lehman at that point. And as you know, a few days later, they actually made a transaction for the broker-dealer arrangement. But the way I understood it on Saturday at 8 o'clock New York time or so was that one of the authorities in England had ruled essentially that if it involved more than, I think, £3 billion, that they couldn't do it without shareholder approval.
Did you get other phone calls that weekend?
I got a lot of phone calls. I had a phone call on Friday night, or late Friday afternoon, on AIG, and they were going to need many, many billions of dollars by the following Wednesday. So I went down to the office on Friday night and looked hard at whether we might possibly buy a very large property casualty operation from them, and spent a few hours then. And then I called Bob Willemstad and I said, unfortunately, I can't do this deal, and don't waste your time with me, so go someplace else. Then on Sunday, after I got back from Edmonton, AIG was in the picture again, and they were looking for an insurance policy in connection with an offer that was being made for AIG. I think it was by Chris Flowers and perhaps KKR and a few people. And they said they were going to go into a board meeting and decide whether they were going to accept this, but if they did accept it, would we be good on a certain type of reinsurance transaction? I said I thought we would. But then that blew up on Sunday night, so it was a lot of action.
Is this different than any time you'd ever experienced before?
It was, except for the Solomon experience I had in 1991 when I was more directly involved. This was a very extraordinary weekend. I mean,
what did you see in the AIG deal, in the offer there, that you thought, forget about it, this is not going to work?
We were talking about buying a property casualty operation that might have sold in the 25 billion range, and what I saw indicated to me I wouldn't have wanted to pay that in the first place, and beyond that it would have required New York State Insurance Department approval and who knows what else, and there was no way to hand over a lot of money by Wednesday of the next week. In
hindsight, do you have any regrets about any of the decisions you made that weekend?
No, I mean I should have been probably doing other things too. No, I am glad we didn't buy that particular insurance operation. I would have done the reinsurance transaction that was involved on Sunday night. The Lehman thing, I still don't understand, even to this day, exactly what the transaction was. No, it was a movie to see, but not to participate in.
Again, if that's the first time that the Oracle of Omaha has spoken to our cameras about what he was doing, what he was thinking behind the scenes on that weekend 1 year ago. Everything was happening around it. If you'd like to see more of it, if you'd like to see that clip again, you can go ahead and check it out online at cnbc.com, buffettwatch.cnbc.com. That's where that clip will be posted again. Now, we're going to be talking to him more about what happened with the economy now. It's a year later, and where do things stand? How's he feeling? And what's he seeing in the many businesses that he owns and that he holds stakes in. So we'll be talking about it with him tomorrow morning on Squawk Mark. We're also going to talk to him about Kraft and the bid that Kraft made for Cadbury, because Buffett's Berkshire Hathaway owns about 9.4%. They are the largest stakeholder by far in Kraft, so his opinion carries a lot of weight. We'll have all of that coming up for you tomorrow morning on Squawk Box. And Mark, back over to you.
Did he venture an opinion on how the Obama administration has been handling things?
He ventured an opinion on health care. We talked a little bit about that, and he has some interesting thoughts. He did not weigh in and say that he thought things needed to be done differently, but we'll have that coming up tomorrow, too, on Squawk and on Squawk on the Street with you, Mark.
Oh, you are such a tease. All right, thanks, Becky. Still
Sure.
a lot more ahead tonight, so don't go away. We've got a whole bunch of stuff lined up for you 1 year later.
Stocks, stocks, and stocks. Next up, how to position your portfolio so you're in the right place for the next run-up. We're talking techs, financials, and stocks beyond our shores. Where's the best place for your overseas dollars? China, India, Europe, Asia, Latin America. Also tonight, ripple effects. It's been said this could be a jobless recovery. If that's true, what'll happen to tax bases, small and large? What's it mean for the services you depend on? We're answering the questions with some people who study this issue 24/7. This is a CNBC special report. 1 year later, the road to recovery.
You're watching a CNBC special on CNBC Life.
After years in corporate sales, I needed a change, selling something simpler, eco-friendly, like LED bulbs. But as a small business owner, I just can't travel the world looking for suppliers. Fortunately, I found Alibaba.com and the perfect supplier for me.
With a world of suppliers and manufacturers in one place, Alibaba.com can help turn your brilliant idea into a success.
Business is looking bright.
Alibaba.com, where smart buyers find suppliers online.
This is no ordinary car. These are no average building projects. An electricity like this has a spark like no other. Alternative investing on CNBC.com is a whole new world of opportunities for a smarter generation of investors. So change the way you invest in oils. Go to alternativeinvesting.cnbc.com in association with HSBC Private Bank.
The whole industry, the financial industry, including private banking, is facing significant changes. Clients are turning exceptionally conservative, so they do less investment activities and more into the basic vanilla products.
So what changes have you had to make to your product offering? Is it all about getting back to basics as a result?
Getting back to basic, yes. Is always, I think the basic products is always on offer with our clients. But with the boom time in the past, I think clients were very interested in more complex, more sexy products, shall we say. Now we have to focus on quality independent advice, as well as new product, new innovation, which we're quite good at, may I say, that cater to the current environment.
It's the $700 billion question.
When you watch CNBC, you're not just getting the latest financial market information.
We're going to cover all the big issues.
You're getting access to the best minds in financial broadcasting.
What are we going to learn from the business community in the UK today?
Every minute of every day from every corner of the globe.
It really does depend on how you slice and dice these figures.
Many faces, one world leader.
CNBC, first in business worldwide. Squawk Australia is your ultimate guide to the global trading day. From the minute Wall Street closes, we track the Australian and Asian markets and chart your investment decisions. As news breaks, we report it. From movements on global markets to the world's biggest corporate stories. News that moves markets and the biggest names in Australian business. Squawk Australia, weekdays on CNBC. First in business worldwide.
We're back. The banks paved the way for this recession. Are they going to lead the way out of it? So far this year, the S&P Financials Index up more than 17%. And if you count from the March bottom, they are the strongest group. Tech's jumping as well. Year to date, the S&P Tech Index up more than 50%. Didn't get hit as hard. So from the March bottom, they are the second strongest group. What should your investment strategy be 1 year after the collapse of Lehman? We're asking Brian McMahon, CEO and CIO of Thornburg Investment Management, Bob Auer, manager of the Auer Growth Fund, Damon Vickers, hedge fund manager for 9 Points Capital. Gentlemen, thank you very much for being with us. Brian, I'm going to start with you. You think financials are cheap? Am I reading this right?
Yeah, I think there's still mileage left in financials. Banks are at about 7 times what we would call normalized earnings, the earnings they'll have once the smoke clears and the write-offs are finished. Smaller banks may be 9 times normalized earnings. And I think you have to look at that against the background of non-bank financial entities being substantially sidelined. So I think bank earnings could go up to 10 or 12 times. And once we see normalized earnings, and it may be 2011, it may be 2012, they'll be interesting.
You're confident you know what normal's going to be, huh?
Eventually, yes. We'll earn our way through the write-offs, and then we'll have deposit taking and loan making without as much competition for deposit taking, and certainly without as much competition for loan making.
Well, Brother Auer here, I believe you're underweight financials, aren't you?
We are still underweight financials, and We have a less sophisticated way of looking at how to go into a bank stock. What we are going to wait for is if we see these bank stocks start to have up 25% quarters year over year and still are trading at a reasonable valuation, which to us is below 12 times earnings, then we will take a look at them. But right now we are in hardly any bank stocks at all.
And Damon, you're looking to commodities, oil, gold to break out?
Yeah, they have broken out, Mark.
That's what I was going to say. Gold sure has.
Yeah. Yeah, you got to love that gold trade, the weakening dollar benefiting not only oil and gas, which we are long, but also benefiting gold, and we're also long that. And those sectors are looking really strong.
You know, what people always ask me when they ask me about gold is, how should I buy gold? Should I buy a gold stock? Should I buy a gold ETF? Should I buy gold futures? Should I buy the actual physical gold? What's your answer? Well, some people, like to have it in their hands. They like to buy those American Eagles or Krugerrands or whatever.
The whole gold coin business is kind of a little murky, particularly between the bid and the ask and the liquidity in those, as I'm sure you're well aware.
Yep.
And taking physical delivery, I mean, that's just crazy. But you can't ignore the technicals and what's happening with gold. This has been a market that for more than 16 months has kept on challenging these highs again and again and again. Mm-hmm. And it really was the topic of late night radio commercials, you know, but really not something you could do anything with. But you've got a valid reason to get long gold now because it's broken out.
But you haven't answered my question. Gold stocks, ETF, gold futures, what do we buy?
Well, you could buy the GLD. We've been in and out of that. You could buy gold stocks, and we do own some of those. I think the gold shares, Mark, may do a little bit better than the ETFs because keep in mind that if gold does actually start moving towards $1,100, $1,200, $1,300 an ounce, which it may very well do, that's really gonna make those gold shares look a lot better. We own Gold Corp in some of our private client accounts, and I think it was up today.
Brian McMahon, I noticed, I did not know this until I read the notes from you, non-dividend paying stocks have outperformed dividend paying stocks in the last year. A, I didn't know that.
Well, that's true, they have.
But B, you expect that to change.
I do expect it to change. There's a shortage of income. There's a shortage of investment income available in the entire developed world, and certainly in the United States. If you'd like some evidence of that, there's $12 trillion in banks and money market deposits, earning an average of around 1%, perhaps a little less than 1%. So a big shortage of income. The S&P 500 dividend will go down by 20% this year, from about $28 to $22. It might go down even more than that. So we're focused on income producing stocks at Thornburg Investment Management, and we view it as a positive thing that they haven't run away like so many other things have run away in price so far.
You got to call it. Thank you very much, gentlemen. Brian McMahon, Damon Vickers, Bob Auer. Thanks for your input.
Thank you.
Next up tonight, Maria Bartiromo goes one-on-one with FDIC Chief Sheila Bair. She's talking about the possibility of more bank failures. Also tonight, ripple effects from the big fall. Now that we're on the road to recovery, will all those American jobs that disappeared in the last year reappear, or are they gone? We're back in 2 minutes.
Information. What if it could find you right when you needed it? Before the board meeting, insight. Before the operation, a second opinion. Before the people who matter make the decisions that matter, they need knowledge. Information that's vetted by experts, analyzed and filtered by the smartest software on earth. Before the deposition, a case history. Before the merger, certainty. Before action, knowledge. Thomson Reuters, knowledge to act.
who's energizing Qatar's economy and helping to create one of the most dynamic and diversified places to do business. The Qatar Financial Center.
It all begins with an idea. Ideas are the source of innovation. Inspiration is the source of ideas. To find sustainable solutions to today's global energy challenges, we must inspire a new generation of innovators. In honor of the vision of the late Sheikh Zayed bin Sultan Al Nahyan, the founding father of the United Arab Emirates and the late ruler of Abu Dhabi, we bring you the Zayed Future Energy Prize, turning today's ideas into tomorrow's energy.
Let's turn now to the opening calls here in Europe. We are seeing support here in the Asian market.
Capital Connection, the bridge between Asia and Europe.
Has been a pretty interesting day of trading here in Australia.
A whole lot of cash up to do for our market.
Live from 3 continents.
A total of $16 billion in market value was lost. Sentiment very cautious here in the Asian trade.
Rather flat opening for the French market.
It's all about the mark of 3,600 points out there.
Capital Connection, keeping you ahead of the game. Weekdays at 12. Wherever you work, wherever you watch, join the global conversation. Live from 5 continents. Worldwide business, worldwide investment, worldwide exchange.
We have the mother of all economic data. That's the jobs report.
The CEO of BP Capital is talking to Squawk.
CPI is coming out today. Housing starts also hitting the table.
Retail sales numbers just minutes
that
away.
Instant reaction and analysis.
Crude is topping new highs this morning.
Let's get the early trading buzz.
A Squawk debate you can't afford to miss.
It's time to get in the game.
Who says the deal's dead?
We've got a Squawk exclusive.
You want experts? We've got experts.
Our top story this morning.
This is a busy week.
Fastest seller ever.
Squawk Box, where business turns first. Weeknights at these times, only on CNBC.
Yes. Thank you. Thank you.
We are back. Scores of banks that were around a year ago are gone. Out of business. Maria Bartiromo spoke with FDIC Chair Sheila Bair earlier today. The big question, are more bank failures on the way? Maria's in Carlsbad, California.
And Mark, calls for major regulatory reform are once again being made in Washington and on Wall Street. FDIC Chair Sheila Bair is clearly one of those taking up the call, but the question is, how much risk is the FDIC taking? The FDIC has been on the front lines throughout this crisis, shutting down or taking over 92 banks this year alone. While small bank scrutiny remains a hot topic at the FDIC, I asked Chairman Bair about the government support of some of the larger banks, whether we have institutions out there that are, in fact, still too big to fail. Here's what she told me.
I think that is an unfortunate outcome. I think we did what we have to do. I support all of the stabilization measures, but it was at the cost of making explicit the too big to fail doctrine, which was probably implicit going into this crisis, and I think, frankly, helped feed the crisis. You know, if investors and creditors think the government's always going to step in and take the downside, so they only have upside, that fosters additional risk-taking. So we absolutely have to have an exit strategy, and most important, I think, of all the reforms that Congress is considering, a resolution mechanism akin to what the FDIC has for insured banks that would apply to any large financial intermediary so that they can be closed and shareholders and creditors will take losses if the government has to step in.
So how do you eliminate the too big to fail? Is it, I mean, can we eliminate this?
I think with an effective resolution mechanism you can. Bankruptcy does not work. That's what Lehman Brothers showed. Because the nature of financial intermediaries, you have to have a government role in the resolution of these very large institutions. But yes, our mechanism works quite well, and we think it can be expanded for any larger financial intermediary.
You wrote an op-ed in the New York Times recently talking about the idea of one regulator overseeing the entire industry is probably not the way to go.
That's not a good idea. I think that's right. And we would think the resolution authority should be separate from whoever the systemic regulator is. We've suggested a council of regulators that could oversee the entire system, both from an institutional perspective as well as a market perspective. I do think bigness has dangers. Whether it's an institution or a government agency, consolidation of too much power, all the power, and a single entity, I think it has a lot of risk. Those single regulator models in Europe did not work well. And I think, you're making a huge bet. If that single regulator is right, well, maybe they can more efficiently implement their decision. But if they're wrong, the entire system is put at risk. The old Federal Home Loan Bank Board was a single regulator. If you'll recall, they did the deposit insurance for the S&Ls. They did the regulation for the holding company and for the depository institutions. That was obviously a disaster. So I think some separation of powers, some check and balances works well. And, we do make decisions quickly when we need to. Witness a year ago, last fall, when we were dealing with the aftermath of the Lehman Brothers bankruptcy. A lot of us worked together very quickly and very efficiently to make some key decisions to stabilize the system.
With some of these banks is still in bad shape and we're expecting further failures, what are your expectations for 2010, 2011, 2012, when people are expecting commercial real estate to weaken?
Right. Well, commercial real estate is a problem. It's a growing amount. Mortgages are still accounting for the lion's share of the losses, but commercial real estate is catching up. And we're going to see more failures driven by commercial real estate, and that's going to be a big factor through 2010. But I'm hoping, at least, again, so much of this depends on economic recovery, which is really something beyond a bank regulator's control. But assuming the economic recovery stays on course, I think we'll be through most of it by the end of 2010. Again, a lot of it's driven by economic conditions, and that's something that's hard to predict.
FDIC Chair Sheila Bair also told me that bank failures will likely continue at a good clip this year. If that occurs, the FDIC will need to tap more funds for these banks. As of right now, she told me she does not know if the FDIC will need to seek more funding help from the U.S. Treasury. We'll be watching. Mark, back to you.
As many industries failed, jobs disappeared. The unemployment rate now near 10%. We're talking about recovering those lost jobs, if possible, what those lost jobs mean for the nation's tax base. Gary Burnison is the CEO of Korn Ferry International, the world's largest executive search firm. William Rogers is professor and chief economist for workforce development at Rutgers University in New Jersey, of course. I'm gonna float a trial balloon here and get the reaction from both of you. Professor Rogers, you first. I'm suspicious, or I suspect, that because of technology, employers in this period right now are going to find out they don't need a lot of the people they let go. What do you think of that scenario?
I think it's potential because we have seen productivity growth was dramatic over this recession, where firms were really pushing their employees, and you're still going to be continuing to see, I think, IT innovations to help grow productivity. But I think really the reason why you may not see as many people coming back as quickly and in the same places is going to be because there still is going to be a great deal of uncertainty about whether you're going to see a double dip or whether we're going to see some kind of Nike swoosh in terms of a jobless recovery. And that's actually where I'm focused on. Is it going to be something more like the 24-month recovery, jobless recovery after 2001, or the 12-month one after 1991-92?
Actually, it was the 2001 recovery I was kind of taking my cue from. I remember everyone kept complaining, jobless recovery, jobless recovery. But we had just gone through a major tech upgrade because of the fear of Y2K. And, the tech made it possible to have a jobless recovery. Gary, your thoughts?
Well, look, I think you can go back 100 years, right? And you could make that argument. Look at the early part of, the United States history and the fact that what we had was plenty of land and not enough people, as opposed to China today. And really, technology was driven by the fact that we had to have it. You could go back to the cotton gin. Clearly, that's the case. I don't think the level of disintermediation is quite what your question implies, but there's no doubt about it. It has an impact. But certainly, despite all the technological innovations of the past century, a simple truth remains, and that is that people drive business.
Yeah. And I think going forward, really what's going to be the key for whether or not, for the pace of the recovery, is going to be coming back to consumption. Right? Well, we know that consumption is about 70% of national income or gross domestic product. And right now we've seen savings rates rise dramatically because households are really trying to get their balance sheets back in order. So that's one of the areas I think we have to really look at, is that because many of the jobs we lost were in retail, professional business services, right, these types of jobs that that were really driven by consumption. So really the pace at which we come back on consumption is going to be very key.
That could be a real problem because a lot of the consumption before the bust was based on borrowing. the availability of credit, which is simply not going to be available in the near future. Maybe someday we get back to that, but I kind of doubt it. Gary,
yeah, I mean, Mark, I completely, I mean, I agree with the comment. Look, it's, you know, there's certainly been some good news. There's a sense of economic normalcy. You know, flat is the old but this great consuming society is doing a lot less consuming. And to see the savings rate jump to 7% from essentially nil, you know, we need some water and sunshine. We need job creation, and we need consumers to come back. And I, quite frankly, think the days of conspicuous spending are over for a while.
In a word, you agree with?
Yes.
Okay, gentlemen, thank you very much. Not exactly, not exactly an optimistic outlook or a sunny outlook, but we've got to figure out what's real. Thank you, gentlemen. Appreciate it. There's more ahead tonight on this CNBC special report.
Later tonight, investing overseas. China, India, Europe, Asia, Latin America. If you're looking beyond the shores of the USA, look no further. That's coming up. Also tonight, housing. It was one of the most affected sectors by the downturn. Where is it now? Which regions are seeing a light at the end of the tunnel? Buyers, sellers, stay tuned. This is a CNBC special. 1 year later, the road to recovery.
You're watching a CNBC special on CNBC Life.
There are a lot of things to explore, and it would be good for people to know all of the sort of diversity that Thailand offers. I love Thai mustard.
She goes every day. So full of life. There's always something going on.
I love Thailand.
As a Forex trader, I chose Interactive Brokers for my business. Unlike other Forex brokers, they don't mark up quotes. I trade with the highest bid and the lowest offer that IB selects from 10 of the world's largest Forex dealers. With group equity of $4 billion, Interactive Brokers is a safe haven for my money. Interactive Brokers. Forex, stocks, options, futures, bonds. Worldwide from one account.
Let's get right into this.
There's about 4 steps in this whole process. The first one is investment banks are going to write down assets.
They're going to debase the value of their US dollar over the medium to longer term.
Second is insurance companies that have done things as outside insurance have to come in and admit to their problems, which is what AIG has done.
Right here, right now, I think Australian banks are in far better shape than US banks.
The third step is along the way you're going to have counterparty risk. People have lots of contracts everywhere, 5 years, 10 years worth of contracts that have been on books that have to be cleaned up. The fourth step that hasn't happened yet, which is still yet to come, is pension funds, insurance companies, endowment funds marking to market their books.
We are likely to see further devaluations occur on the balance sheet.
We are close to that mythical point of maximum opportunity when people are nearly as pessimistic as they can be, and typically that's when you get to a bottom.
The opportunity today is much better than it was 6 months ago.
I want to put cash to work in the equity market.
Trading Matters, your essential guide to the Australian equity market. Weekdays at 2 on CNBC. Get the news first.
Our first on CNBC interview.
The investment into China and the investment into the Beijing event has already paid back.
We are not exposed to oil prices at all.
First on CNBC interview.
Well, we're the #1 market share leader in almost every segment and every market we serve.
It was a record quarter for Intel. It was our 4th consecutive quarter of record revenue.
We just want to keep a little bit more cash in the company.
Only on CNBC. First in business worldwide.
Malaysia looks forward to being an active player in terms of the ASEAN free trade market. 550 million people, that's a big size market for us.
China is part of our future and a part of our future development.
If you look at the creditor nations in the world, they're all in Asia now. China, Japan, Korea, Taiwan, Singapore, Hong Kong. The money is in Asia now.
A new day is dawning on Wall Street.
Lehman Brothers stock lost 94% of its value today on that bankruptcy filing.
$150 billion lost at AIG. Merrill Lynch, for all intents and purposes, is gone.
Everybody but the U.S. government knew what was going on.
If you're gonna make a deal with the devil, you're gonna sell your soul.
The government doesn't want to do this. They've been begged to do it by all of these masters of the universe on Wall Street who are suddenly going down the toilet.
Wall Street is bracing for another white-knuckle day of trading. We're back. One of the hardest hit sectors over the past year has been housing. Home values down pretty much across the board. The good news is at least the rate of decline is slowing, but values are still declining. Armando Falcon is the former head of OFEO. It's now called the Federal Housing Finance Agency. Spencer Raskoff is with Zillow.com. Susan Wachter is a professor of real estate at the Wharton School of Business. Go Quakers. All right, let's start with Zillow.com. You keep track of housing values, right?
We do, Mark. What are you seeing? Well, you're right. I mean, the bad news is home values are still declining. The good news is the rate of decline is finally starting to slow. So in May, for example, home values declined about 11% year over year. In June, they were down 10.5% year over year. In July, down 10% year over year. So the rate of decline is starting to slow, but home values are still declining. Some markets are starting to find a bottom. Boston, for example, after 40 straight months of declines, Boston is now basically flat year over year. So we are starting to see some glimmers of hope in some parts of the country.
Armando, isn't it true that the government pretty much is the mortgage market right now?
It absolutely is. Investors have exited the mortgage market and they've left it to the federal government, whether it's through FHA or through Fannie Mae or Freddie Mac.
That's not a good sign, is it?
No, we want the private sector to be in the mortgage market. At the peak of the housing boom, we had over 60% of the mortgage market was in the what we call the private label securities market. So we had investors very aggressively into the mortgage market, and the share by Fannie Mae and Freddie Mac and FHA was less than the majority of that.
Professor Wachter, what's the outlook for a recovery here in housing?
Well, we're not near recovery. That's much too strong a word. We're still in the bottoming out phase, but we will get to recovery. But recovery itself is threatened by that very fact that Armando said, that we are right now relying on federal support and we need private capital at risk.
How do we get that, Professor?
Well, that, of course, is the question. We're going to
What needs to happen?
First of all, we need to see far more of a recovery. We need to see recovery because the banks themselves are not lending. They still have the toxic assets at risk. We need recovery before we can see private capital at risk.
Armando, you're expecting a long, slow recovery, huh?
I believe we will have one because private investors need to see stability in the housing sector. They need to see a true bottom. I agree with the fact that the decline in home prices is slowing. The pace is slower. However, I think that could be easily overwhelmed by another statistic, and that's the growing rate of delinquencies and foreclosures among homeowners. That could easily negate any of the positive signs that we're seeing.
Well, I'm glad you mentioned that. Spencer, following up on what Armando just said, I believe I've been reading that the crust of foreclosures isn't even going to hit until sometime next year, right?
Yeah, it's scary. I mean, 1 in 5 homes that sell now are being sold as part of a foreclosure process, but 1 in 4 Americans now have negative equity in their home. And there's over $100 billion of option arms that are going to reset between now and 2011. So there's a whole other tidal wave of foreclosures that's going to come, and that is going to lead to a very slow recovery. The other thing that's scary is there's a lot of sideline inventory, sideline sellers that are waiting for the right time to sell. About a third of Americans say once they think the market has improved, they would like to try to sell their home. So there are a lot of people waiting on the sidelines, and that glut of inventory is going to come on the market as soon as we start to see bottom. So it's going to be a slow recovery. Unfortunately, it will be more like an L-shaped recovery than a V-shaped recovery.
Professor, think back to what you were thinking and reading and seeing a year ago. Did you think that a year later, today, we would be in the shape we're in, whatever that shape is?
Well, we were looking at fears of a Great Depression a year ago. So today we have a Great Recession, and I think that would have been something which would have been regarded as a good outcome then, and it's a good outcome now.
What is the key to getting things going?
Well, we do have to see that bottom, but, you know, there's going to be a long L shape no matter what. And then the other key is unemployment. That foreclosure spike that we're going to see is also being driven by increasing unemployment.
Is the new, I'm going to ask you all, because I think we're running out of time, I'm going to ask you all the same question, starting with the professor. What will a new normal look like?
Well, the new normal is going to have a rethink completely of the federal support for the mortgage system and the too big to fail banks out there.
All right. Spencer, what do you think? The new normal.
The new normal is going to be, once we've hit the bottom in 12 months or so nationwide, it's going to be 3% appreciation over the next 10 years, and that means that buyers are going to have to think about living in their home for 7 years and really wanting to buy that home as a place to live, not just a place to park money and a place to invest.
Armando, out of time. Make it quick, please.
The current situation goes on 3 to 5 years, and eventually we move to hopefully a new private sector-based system.
Thank you, ladies and gentlemen. Armando, Spencer, Susan, thank you very much.
Thank you.
Next up, going where the money is. We're talking about investing overseas when we come back. This, of course, is CNBC, and we are first in business worldwide.
Working with millions of clients around the world, we provide clarity where there is complexity, ideas and advice that lead to opportunity, and solutions across the financial spectrum, creating value through our financial strength and expertise. Deutsche Bank, a passion to perform.
ITB Asia 2009, the trade show for the Asian travel market, comes to Singapore for the second time. Industry professionals from the MICE, leisure and corporate travel world come together and meet with international exhibitors representing the full range of travel products, services and goods. Get insights from some of the best minds in the industry at Web in Travel, Asia's leading travel distribution, marketing and technology conference, as well as other events. Visit our website for more information. Register now. Malaysia International Islamic Financial Center presents.
London and Malaysia have chosen each other as being appropriate collaborative partners in the development of Islamic finance. We have very good collaborative relationships in a number of areas, starting with education. Malaysia, gateway to Southeast Asia, has been leading development and thought processes in Islamic financial products.
Malaysia has really recognized the importance of talent development. The uniqueness about Malaysian approach is we more or less distinguish between education and training towards meeting industry needs.
Malaysia has had a lead as an issuer of sukuk. There's been a desire from the business community in the UK to get closer and understand better the Islamic capital markets in Malaysia.
Presented by Malaysia International Islamic Financial Center.
Squawk Box Rewind.
I think the banks do need to be focused on foreign currency liquidity, continued strong capital levels, and a more diversified underlying business mix. Traditional banking in Korea is rather net interest margin or NIM driven, and I think there's an opportunity to increase the stability of banks and the profitability of banks for more fee-based and other businesses.
Squawk Box, where business turns first. Weekdays at 7 a.m. CNBC's Cash Flow, where we help you cut through the noise and get to the bottom line.
What's looking attractive across Asia?
Looking for opportunities across the markets.
The defensive, tactical.
Well, what a difference a day makes.
Market up, market down.
We're in this delicate dance as well at the moment.
Giving you the edge to stay ahead.
This is particularly interesting.
Gold stocks have really been a safe haven.
So there is really unprecedented opportunities now.
What in particular are you looking at?
CNBC's Cash Flow, weekdays at 10 a.m.
It was a year ago today that Lehman Brothers filed for bankruptcy, and the crisis hit the global economy like a tidal wave. Some called the slowdown a once-in-a-century crisis. Have you ever thought about the fact that Wall Street's the only place where you can have a 100-year flood every 10 years or so? 11 economies around the world improved in July, including the BRICS, Brazil, Russia, India, and China. So we're talking about investing outside the U.S. tonight with a man who's expert at being outside the U.S. Simon.
Good evening, Mark. How are you?
Simon Hobbs, CNBC's Simon Hobbs, John Brown of Euro Pacific Capital, and Douglas Smith, Regional Head of Research of the Standard Chartered Bank. Gentlemen, I have to warn you that Simon intends to ask questions too. So let's get started. John Brown, where would you put outside the U.S. your money right now?
Well, first of all, Mark, may I thank you for many years of great insight, information, and great entertainment. It's marvelous to meet you at last on the air.
Are you talking to me?
I would be outside. Yes.
Well, thank you very much.
Mark, no, every morning I watch and have done for years. Thank you.
I feel the same way about Simon.
Thank you, but I think really in what I call the brick can, Brazil, Russia, India, China, and their supporting resource countries like Canada, Australia, and New Zealand. That is where I really look, particularly Australia and New Zealand, because they have really feeding the engine into the Far East to China and things with resources. And although the world trade is going down, in that local area, world trade is still rising fast in terms of resources. And so I would favor that area. Europe is, like all the industrial countries, has got to face massive deleveraging, just like the United States. Lehman Brothers was a bold start, but the government, when it faced AIG, shirked it. And so we are not facing deleveraging. We're just postponing the problem. And now we're in that eerie calm or the eye of the hurricane. And that can be misleading. So I think one should seek the safety of a safe house, which is the brick can countries, if you're going to invest in equities.
All right. Douglas Smith, your thoughts.
Well, we actually, we're quite bullish on Brazil. We see positive growth in Brazil this year. The economy is not export-led. It's very much driven by what goes on domestically, and particularly domestic consumption. So you have a central bank that's lowered rates. You have a government that for once in a considerable amount of time has a big fiscal war chest to step on the gas with their own kind of cash for clunkers, for example. And you're seeing that pick up with industrial production. And like I say, it's one of the few countries where we see positive growth this year, and we're actually worried about when they start raising rates in the first quarter of 2010.
Douglas, let me ask you, I mean, the world and their dog have headed off towards the emerging markets. Everybody's overweight and underweight the United States and Europe. What about the timing of this? You know, if you're in emerging markets, you're going to get an amplified response on any general move that you have in world equity markets. And there are a lot of people, as we've heard throughout the programme, who think that there's a pullback to come. That presumably could be quite a severe pullback in the areas in which you're invested.
It's possible.
Well,
I
it's
mean,
more likely to be pulled back in the industrialized nations, and you've got the currency appreciation potential in these other countries. I mean, Australian dollar is up 32%, New Zealand dollar up 41% against the US dollar, but that there is before a rise in interest rates. And those countries, because they're resource rich and exporting resources, they're likely to have an exit strategy from government stimulation and to raise their interest rates before other countries, attracting more appreciation of their currencies in addition to the stock appreciations.
Yeah, thank you for that. Do you want to come back, Douglas? I know you wanted to get in on that particular point.
Well, sure, but on the interest rate exchange rate point, like I say, we do think that there's the risk that they raise rates sooner than the market thinks. But given that Brazil is very much driven by what goes on domestically, it's sort of like the United States in the sense that the movements in the currency have little effect on its external trade. They are quite tolerant of further currency appreciation. So that's not something that we worry too much about.
And the classic thing for me to ask you about Latin America is political instability and moving to the left. But I see the analysis is that actually of the 12 elections we've got in Latin America and the Caribbean coming up, the view is actually that the move to the left is going to be muted. It's kind of a threat that is going away. Is that your view?
More or less. In the case of Brazil, you've actually had the move to the left. They elected the guy that was very frightening years ago, and he turned out to be quite reasonable. Now, there was some good policy, of course, and they also had a bit of good luck with the commodity boom. But then, say you look at a place like Mexico, where they don't have elections for a while, but they've never really elected the guy that the market was really frightened about. So in the case of Brazil, when we look at the candidates that are coming up, we think that while there'll be some noise, they're actually both quite the same and well known in the market.
John Brown, I see in my notes you say the euro and the Swiss bank are hurting things. What do you mean? Could you expand on that?
Swiss franc. I mean, the euro is at an all-time high against the.
Oh, I
didn't think I said Swiss bank.
All right,
Swiss
fair
franc,
enough.
I said. But the euro is at an all-time high against the US dollar, and of course that hurts countries like Germany, which is the largest exporter in the world, and the same for Switzerland. And they're not natural resource; they're industrial exports, not natural resource, so it hurts them.
Is there hope for the dollar?
I don't think so in the short term. I think America's facing a very serious problem. It was the most over-leveraged, an exponential rate of debt, which usually in commercial terms presages insolvency.
All right.
And I think America has shirked going for the deleveraging, whereas some of these other countries are allowing deleveraging to take place, and they're going to be gaining competitive advantage.
That is all for us tonight. Thank you very much for watching. I'll be back tomorrow morning, 9 a.m. Eastern Time with Aaron Burnett on Squawk on the Street. We'll have Anheuser-Busch's CEO, so don't miss it. 9 a.m. Eastern Time on CNBC.
You're watching a CNBC special on CNBC.